From WBRN Radio in Boston and on the Bostonred Network, this is This Week in Economics by Numbers Man, one of our many alter egos running around here. This is a macroeconomics program, and we'll talk about it and where the Fed and where the economy is as we adjust to what can be termed Trumpnomics. One thing to note here, it takes a number of months to get an accurate picture in what is going on. Particularly, we're in Q1 now, a new quarter, a new year, and a new economic program that is really not mature at this point in time. The federal budget has sort of leaked out, increase in military spending that would affect certain sectors, building of ships, etc., although the labor force for building of the ships is not in place, and this is over a 10-year period. I was just looking at an article about apprenticeships. That is something done in Germany, and what it targets is people that would not go to university. One thing to note, different history in Germany as to a history in the U.S. The U.S. has a history of colleges being open and education of the populace in a liberal format, which is quite different. Most young people in the U.S. are allotted the opportunity to go to university at some level after matriculation from secondary schools. And there is also some vocational training. The problem they've had in the U.S. with vocational training has been running behind the curve. An example was 30 years ago, we were training people to be welders and had a surplus of welders. Now there are very few welders out there because there's been very few things to weld in a global economy. Now, this is one thing to look at a global economy is a bit different. You have people from various countries that specialize in various things, and that in itself is to be understood. The U.S. has taken a lead in technology, particularly in technology as it relates to the Internet of Things, but that competition has been heating up for the last 10 years, with the 20 years ago with the Internet being popular. Most of the people that were on, popularized I should say, most of the people that were on the net were in the continental U.S. and the industries that were in the continental U.S. And then, of course, Europe played a role in it. But at the same time now we see China as being the biggest Internet audience in the world, India, where you have billions of people, quite literally, and now in the 120 continuous countries in what is commonly referred to as quote-unquote Africa, the Internet and the Internet of Things is taking hold, particularly in Nairobi where IBM is, and all these items affect the broader economy, and they weave themselves into macroeconomics because central banks, and it doesn't matter which nation it is, and the European Central Bank play a very important role in setting economic markers. That be it, let's go to some of the information here, particularly on inflation. The Fed had increased their rate at 0.25 or 25 basis points, however you want to have it. This advanced monthly sales for retail and food service is released, this is for February of 2017. It was released on the 15th. Monthly retail sales estimates will be revised based upon the results of the 2015 annual retail trade survey. The next release will be on the 26th of April. Nonetheless, was $474 billion That was in February, 473.6 billion, revised in January of 2017. That is a plus 0.1%, and plus 0.6% in January. Now, adjusted for seasonal variation, holiday, trading days differences, etc., we gave that a number, and from the previous month, 5.7% is above the February 2016. Total sales for December 2016 through February 2017 period were up 5.4%, or 0.7 from the same period a year ago. The December 2016 to January 2017 period was revised up 0.4%, up to 0.6%. Retail trade was up 0.1% here, and gasoline station sales were up 19.6%. This is something we look at very, very carefully, particularly as it applies to discretionary income. While the non-store retailer sales were up 13%, and that's 1.8% from last year. So retail sales are up. Brick and mortar retailers at the same time are closing up. So this is from the U.S. Census Bureau, and that is the information here. And just let me get into where the action is, so to speak. This is 2 months total here. Retail and food total for 2017 at 3.7. That was the change from 2016, excluding motor vehicles and parts, at 740,519. Motor vehicle dealers at 1,705.98. That is a change of 3.7 here. New car dealers 4.2 there, and this is in millions. So again, 173,593 here. Home and furniture and home stores at $16 million here, and was up 2.1%. Electronics and appliances, 14 million, and it was a negative 5.6% there. This includes TVs, cameras, computers. They were down. Building materials at 6.1. It was up $49 million there. Food and beverage stores, a negative 0.1 there. Grocery stores, a negative 0.4. Wine and beer and aspirate there. Gasoline stations up 14.8, or $64 million. Clothing stores at $34 million. Unchanged here. And general sporting goods was down, and you see some of the national chains filing for bankruptcy, down 5.1, and it's $12 million there. Department stores, $19 million, but they were down a negative 7.3 there for department stores. Miscellaneous retailers at 1.8% there. Non-store retailers at 11.5%. Food and drinking places at 2.4%. That was the increase there, and 104 million. And again, this is estimated change in monthly sales for retail and food services by the kind of business. And this is a table in the second table here. retail and food at 1/10, and February of 2016 it was 5.7. You can see the difference here in those terms. Motor vehicles dealers at a negative 0.2%. That was in January of 2017, and in February of 2016 it was 5.6%. So we are seeing some level drops here. Electronic and appliance stores were down in in January 2017 at a negative 2.8. In February of 2016, climatic conditions there, a negative 6. Building materials 7.3 in February of 2016, 1.8 here, so a slowdown there. And clothing in 2016 at 1.6, it was a negative 0.5. Sporting goods, we have been in the negative 0.4 in 2017, January of 2017. The negative 3.6 there. So this is some of what is going on. Drinking places were down, food and drinking places down 1/10 here, and it was 3.7. It was a much better year at that particular time. So this is the estimate measuring of sampling variation revision to advanced estimate. This is for February. We won't go through this, but basically we'll look at gasoline stations 1.8, sporting goods 2.4, general merchandise at 3.2. This is for February. So let's go on here to the Consumer Price Index. This was issued on the 15th for all urban consumers, increase of 1/10 in February on a seasonally adjusted basis. The February increase was the smallest one-month rise in the seasonally adjusted all items index since July of 2016. For all items, rose at 2.7 for the 12 months ending in February. The 12-month increase has been trending upwards since July of 2016 at 0.8%. The index for all items, less food and energy, rose 2.2%, a little bit up there. The reason the Fed acted when the Fed did, in fact, act. And if we look at food here, well, we get a 0 on that, but nonetheless, 2.7, that is all items. And food away from home, or takeaway, depending on how you want to call it, 2.4. Energy was up 15.2. This is the one we really look at very, very carefully. Energy commodities at 29.8, gasoline at 30.7, fuel oil at 28%, energy services at 3.8, electricity at 1.9. And in August of 2016, we were at 0.3. In January, there was no indication there. So we are looking at it very, very carefully. Commodities, less food and energy, a negative 0.2 there. Vehicles, new vehicles, a negative 2 there. Used cars at a negative 0.6. Apparel at 0.6. Medical care commodities in negative 2. It was in August 1.1. Services, less energy, 0.3 shelter 0.3 3 there, and transportation services 0.7, a little better shape. Medical care services at 0.2. It's been down, and we get a 12-month period here. Medical services, or medical care, I should say, would be at 3.4. So from Bloomberg, looking at retail sales in February posted the smallest gain in 6 months. That is something to look at, but February historically has not been a bang month. But retail electronics and appliance stores, apparel stores, car dealers a sign of more moderate consumption in Q1. Q1, we usually see this after the holidays. There's some relaxation. But what we'll be looking at is the last part of Q1 and into Q2. Now, if this continues, purchases may have been restrained by temporary slowdown in individual income tax returns. It tells us something there was relatively weak, and one of the reasons delay of income tax returns. Part of this is due to Eugenio Altman at Wells Securities in Charlotte, North Carolina. Still, confidence numbers are through the roof, and if employment continues to grow, it's only going to strengthen the consumer. Well, if the consumer is dependent on their tax return, that doesn't tell me as much as that particular analyst. Estimate for retail sales in the Bloomberg survey range from 0.3, a decrease to a 0.5 advance. Figures used to calculate gross domestic product, which excludes, of course, food, services, home improvements, etc., rose 0.1. Well, that is to be there. Separate reports from the Labor Department show the consumer. We just talked about that. Inflation there compared with a year earlier. The CPI was at 2.7% most since March of 2012. That was after the country was coming out of the Depression. That is not unusual. Part of the reason for weak retail figures, which aren't adjusted for changes in prices, may be due to change in laws that affect tax refunds. The Internal Revenue Service said that filers wouldn't receive refunds until the last week of February. So they started to trickle out. And normally in the tax business, once the filing period started in years past, you could receive your returns in January, because they are filed electronically, and that information is already there. 127 billion in refunds were processed this year through the week of the 24th of February, about 10% less than the same period in 2016. Many times what happens with tax returns, they are used to pay off last year's credit card bills. The industry this month showed car sales in February were a little change from a month earlier. Cars and light trucks sold at an amortized rate of 17.5 million pace. That's based on Ward's automotive data. Sales at stores that sell electronic appliances slumped 2.8% the most since December of 2011. Receipts at gasoline stations fell 0.6, while sales dropped 0.5% at clothing stores, too, at general merchandise stores. Part of the reason increase in the price of petrol in the U.S., and when you have that, you will get that sort of thing happening. Let me just make sure that we've got everything we need here. Okay, we have got it looking at the same thing. And from Reuters, basically the same information here from the Department of Commerce. The later than usual processing of income tax returns again, the IRS is now caught up to last year's pace. So a bump in March. We're in March now. This is from Guy Fletcher, Deputy Chief Economist at PNC Financial. So the 12 months of the CPI accelerated. We talked about that to 2.7%, the biggest one-year jump since 2012. The CPI rose 2.5% in the year to January. Inflation is firming in part as it did in the 2015 a drop. The so-called core CPI, which strips out food, increased 0.2%. Last month as new vehicle prices fell. Apparel moderated after spiking in January. In the 12 months, the core CPI increased 2.2% after advancing 2.3% in January. It's the 15th straight month, year on year. The CPI remained at 2.1 tenths to 2.3 tenths. Slow growth. The Fed has a 2% inflation target. You've heard about this, which is currently at 1.7. The central bank, of course, raised its overnight bench interest rate 25 basis points to a range of 75 to 1%, which is very weak. The dollar weakened to a 2-week low against a basket of currencies, while the U.S. Treasuries rallied. February retail sales added to a January week report. The Atlanta Fed is forecasting a GMP to rise at 0.9% amortized rate in a Q1. When the labor market is near full employment, slowing growth probably understates the health of the economy, and GMP tends to be weaker in the first quarter because of calculations issued. I mean, we went over that. And work is to roll. In February, motor vehicle sales fell 0.2. We highlighted that. And electronic appliances recorded their biggest decline since December of 2011. The largest drops, retailers included JCPenney, who has been on the cliff, Abercrombie and Finch, and let's see who else here. Macy's, which is closing stores right and left, or left and right. A scaling back of the brick and mortar stores, moving on with the Amazons of the world and various other imitators out there. Retail sales jumped 1.2 last month's receipts at building material stores increased 1.8. That is not a bad pace to be at. Let's go to the BBC now and look at our international roundup. Mr. Chuck Berry has died, a legend. May he rest in peace. He was 90 years old. Anyway, to the business part here, the G20 drops anti-protectionist pledge. This is not a positive development at all. Here, because when you start to get protectionism, is who is protecting whom. The G20 ministers left for their 2-day meeting without renewing their long-standing pledge to boost so-called free trade, which is not necessarily free. They vowed to resist all forms of protectionism, sense of the new regime on American First policy. Speaking after the meeting the Treasury Secretary Munchin said he would not read too much into it. Well, there is a lot to be read into it. The communique was published at the end of the meeting, no doubt. Failed to include a vow on climate change. That is also changing here, Will. And all of these changes have effects, either positive or negative, and this is one of the things to remember from France, Michael Spaken. I regret that our discussions today were unable to reach a satisfactory conclusion on two absolutely essential priorities that our world and which France would have liked to see in the G20. However, it did include a pledge on a determination to fight tax avoidance, clamp down on terrorist financing, and strengthen private investment in Africa. Protectionist policies, a number of discriminatory trade measures implemented by G20 members between November of 2008 and September of 2016. The U.S. is number one, India, then the Russian Federation, Argentina at about 400, and Brazil, and Germany less, and the United Kingdom, Italy, and at the bottom is South Korea, Mexico, South Africa, Canada, less than about 150, whereas the U.S. is over 1,000 there in those complaints there. So not a lot of change, but some change here with the G20. And this will start to impact the overall picture, because if you get protectionists, you are starting to have problems, period. Brazil, Packers sold bad meat worldwide. Not good for Brazil, a big meat producer. Suspended 13 government officials. The country's biggest meat processors had been selling rotten beef and poultry for years. Oh boy. These processing plants have been closed, and another 21 are under scrutiny. The meat producers accused of exports to Europe and the other part of the world. Brazil is the world's largest red meat exporter. Not good at all there. JBS. In other cases, potato, water, and even cardboard paper were mixed with chicken meat to increase profits. Well, the water and cardboard, JBS said in the statement, followed rigid standards, etc. They used acid and other chemicals to mask the aspects of the product. In some cases, the products were carcinogenic. Police said 30 companies and a number of unhygienic presses, including them, are JBS, the world's largest beef exporter, and BRF, the world's top poultry exporter. So we'll be looking to see where we're getting these. JBF has net revenues of $55 billion, or 44 billion pounds. Exports to 150 countries. Shares have flattened by 10% and 8% respectively. That's JBS. We'd hope so. Prosecutors say the percentage of bribery money was paid to two parties there. So Brazil, a basket case of things coming forward. One of the things we need to know about the market and where the market actually is and what we're actually getting. And this is very, very important here in an international world. Let me just see. We'll go and do the numbers here and wrap this up. Not a pleasant news at all coming here. A new long-haul airline has been BA launches a LAG long-haul airline new airline with initial flights to Los Angeles, Oakland, Buenos Aires, and Dominican Republic. From June, the airline will use Liberian crew and 2 new Airbuses, according to this. Based in Barcelona is where it will be. Fares will start at about 99 euros, $140 each way. So we'll see. This new airline is coming in there. It'll operate with Boeing 738 service. This is from London and various other places. Last month, IAG reported a 64% jump in profits. So it's kind of interesting. International Consolidated Airlines. Get something new every day. Anyway, on to market data here. Big data, as we call it. It's always out there. And see where the markets are in this macroeconomic world. Nonetheless, the BBC Global 30 was down 17. In London, the FTSE All-Share was at 6.85 on Friday, and these are Friday unless otherwise noted. In Amsterdam, they're at 1.71. In Frankfurt, at the DAC, at 12.06. In Paris, they were at 15.86. In Brussels, at 21.73. And in Madrid, at 77.80. In Zurich, at 31.05. In Moscow on Friday, they were at 22.58. In Johannesburg, they were down 294.82. In Bombay, 63.14. In Karachi on Thursday, they were down 16.17. In Lahore on Friday, they were down 45.11. In Colombo on Friday, 19.27. And Wednesday in Tehran at 98.80. Sydney on Friday, 13.30. The Nikkei on Friday was down 68.55. The Hang Seng in Hong Kong at 21.65 on Friday. And in Shanghai, they were down 31.49. In New York on Friday, they were down 19.93. The Nasdaq 0.24. The Merck was down 3.13. That's a commodities market out in the Midwest city of Chicago. San Pablo, on Monday, they were down 1,046.17. And on Friday in Mexico, they were down 648.42 to the commodities. We watch very carefully in petrol in particular. Brent crude futures up 7 cents at $51.81. The spot was up 16 cents at $51.35. West Texas Intermediate crude was up 1 cent at $48.74. T-Boone Pickett still jumping for joy there. He remembers $15 a barrel oil. Cocoa futures were down $14. Sugar was down 8 cents. Gold on the Forex futures were up 25 cents at $1,229.60. Dubai Gold futures were up $1.50 at $1,228.40. Silver was down 6 cents at $17.40. It's been going up over some time here. Eurex Life futures, cocoa down $9. Winter wheat down $2.25. Robusta coffee down $6. And the Bloomberg Commodities Index was up 3 cents at 85.14. So commodities were up. Pretty good week there. The price of petrol has been going up and down, and of course the end product that most people see, gasoline in the U.S., has been up and has been down, and it does impact the overall economy. This will do it for us, for those in business. Make next week a productive one. For the consumer, the eyes are on the prize. The tax returns are coming, and that will give a stimulus to many, and it will pay the credit card merchants for many of us. And as we await the budget, specifically in particular areas that could be hit very hard, the Washington, D.C. area we think of, in that whole northern Virginia, Maryland, etc., with the redundancy of federal workers across many of those departments, so that will come, and also how it will impact research, the national sciences, etc. This budget as it shapes up. We'll start to actually see where the cuts will be, and of course the whole healthcare scenario is up in the air. The plan by Speaker Ryan and company is in chaos. They are having to revise a number of things, and the problem is you can't run tens of millions of people out of the healthcare service and have any type of stability because of the dollar amount that healthcare plays in the economy. So you have the American Hospital Associations, etc. Those trade associations were opposing it, and now the votes in the Senate is simply not there, and they are rethinking the entire program. What is basically happening here in overview is that the Affordable Care Act, or Obamacare, is to be replaced by a private, more or less a private alternative. And that in itself has not worked. It would benefit certain sectors. Now we have in the U.S. a penalty for not having insurance. That disappears, and then the insurance companies could charge up to 30% for people that were not insured the previous year. So we're looking now at 2018, what changes will take place in 2018, 2019, 2020. We do not know. The exchanges would supposedly continue to operate. Whatever enhancements or credits will be there will be very important in a macro sense. And perception also of what is going to happen. That's where it's very, very important in the budgetary battle on the discretionary part. Now, military spending would increase, as we talked about when we came into the program, the shipbuilding aspect and even this apprenticeship scheme that they've been talking about. But those are more long-term, creating larger numbers of apprenticeships. It can be, as they say, put out there, but it's difficult to do because the education apparatus is not there. And in many states, especially, say, Texas, a very large state, the amount of education in the budget has been decreasing and has alarmed the business interests in that state. So you have all of those factors playing in here, and at the same time you have large college debt, and they are now moving to let so-called debt collectors, parasitic elements in the economy, go after students that are in arrears, say 3-6 months, whatever. That was blocked under the Obama administration. And all those things play in because, again, that plays with discretionary incomes of those people and the portability, just as the immigration ban is now on hold, and we forgot to mention that, out in Hawaii because of tourism, and the tech industries are all opposing that because that will impact them negatively in terms of their workers. Now, some of those enterprises are moving into Vancouver, Canada. So you're starting to see some of that happen. And again, in this whole protectionist situation, does it run with the American first philosophy, or does that make America last? That is a political question, but it is also an economic question in how this spins out. Because over the past roughly 20 years, particularly the last 10 years, much of some of the industries have moved from North America to other parts of the world. Now, if you start bringing those back, where do you find the workers to do that? And in particularly in the high-tech industry is totally dependent, almost totally dependent, on workers from other countries, on various types of visa arrangements, various types of living conditions, even those that are citizens. If you start to have a very hostile environment, it's what happened to some Indian nationals. They will be much more reluctant to come to this country, and that plays into many, many things. They will go where it's friendly, and at the same time with better broadband out there and more internet accessibility, particularly in places where we didn't have it. A few years ago, Cuba, for instance, in Nairobi, Kenya, now fiber optics is there, and it's getting much better as the industries develop. And in technology, things develop very rapidly. Moore's law processes double every 2 years, but that can also be going to self-driving cars and other sorts of devices.